What's up everybody, Nate here, and Americans are in a lot of debt. And if that was news to you, you're welcome. Debt in the United States has been growing for each consumer over the last few months, from the buy now, pay later financing companies to student loans and mortgages. Americans are now further in debt than they pretty much ever have been in the United States history. But there is one more serious point of debt that is growing faster than all of the others, and that is credit card debt. Credit card debt is up to nearly $1 trillion in the United States as consumers are increasingly relying on the little plastic cards to pay for all of their finances. But increasing credit card debt has a lot more disastrous implications for our entire economy than just Americans who are much more in debt than usual. So what exactly is going on here? Well, we have credit card balances going up in the United States because a lot of consumers are reeling from all of the effects of inflation and the pandemic. Inflation in the United States is currently at around 6.5%, and in the summer of last year it was at around 9.1%. So inflation has fallen a little bit, but it is still really high. And when you have really high inflation, that means that everything in your economy is going up in price, and Americans are not making enough in their wages or their salaries in order to pay the new price for all of the same things. So when you have buying power going down, that means Americans have to rely on something else in order to buy all of the same things, and that usually comes in the form of credit. The average credit card balance for an American right now is around $5,000, and they continue to add to that because the cost of living and the cost of everything else continues to go up. Now, one of the other reasons why Americans have been spending on credit cards in 2022 and now in 2023 is because of how our economy has sort of been shaped over the last couple of years. There was a lot of money flowing around our economy in 2020 and in 2021, and to be fair, many Americans actually paid down all of their credit cards in full. So they had zero balances on their credit cards in general, and that was a really good thing for our economy at first. Americans then had all of this extra money because of stimulus payments, and they went out and spent this money. Now, a lot of that money ended up going into new cars and mortgages and things that consumers really needed or just really wanted. Obviously, a lot of that stimulus money was used for good purposes, but there was a good chunk of Americans that spent this money that didn't really need that stimulus cash, but they got it anyway, and that sort of created a lot of the inflation that we're facing now because there was an excess of demand that was really artificial from the Federal Reserve. But then 2022 came along, and all of the stimulus measures seemingly ended, and all of the programs from the federal government also ended too. So now you had Americans who had this standard of life that they were used to living, but all of a sudden they didn't have the money to afford it anymore. Now they started to go after the credit cards, and many Americans who paid off their credit cards were looking at those as an extension of their income, because now they have all of this credit that they can use, and those balances are near zero, so they can rack up as much as they want. So that is one potential that we could be seeing from all of this credit card usage, and the other potential is the effects of inflation. I mentioned before that inflation means that the value of all of your dollars are going down and the price of everything is going up. So now Americans need a whole lot more money in order to buy all of the same things, but businesses haven't really been able to shell out any more cash because they're not getting investor liquidity and they're not getting any money from sales. So they don't really have any extra money to give. Because of this big demand spike, because of all of the dollars in our economy right now, well, the Federal Reserve, who kind of controls our monetary systems in the United States, they want to bring down inflation. They want the value of our dollars to go back up. So what they have started to do is raise their interest rates. Their interest rates control demand in our economy for money. So with interest rates going up, that means demand goes down because it's a lot harder for people and banks to take on that money, and that includes investors and businesses. So when you have interest rates going up, demand goes down. In 2020 and in 2021, interest rates were at 0%. So it was really easy for people to borrow money. It was really easy for people to go out and spend money, and our economy really needed that because at the height of the pandemic, we didn't really know what was going to happen next with pretty much anything, right? So the Federal Reserve wanted people to go out and spend, and they incentivized people to do that by lowering their interest rates. Now interest rates are going up. And that is a serious problem because businesses are not getting the investment that they need right now. Investors want to get a good return on their investment, and they borrow money from banks. They borrow in order to invest in companies. So with interest rates really high, they're not going to be able to get a solid return on their money. So investors just aren't investing like they used to. We've seen VC, private investment, and public investment drop in 2022 and in 2023. So with that investment dropping for companies, now you have companies that aren't able to kind of meet their top and bottom lines. They can't invest back into their company, and they can't hire new people, and it's really hard to keep the people that they have. So that is part of the reason why we've seen big layoffs in 2023. It's part of the reason why we could see unemployment actually rise this year. And then you have the consumer side. So with prices going up so rapidly, well, Americans only have so much money that they can spend, so they're not spending as much money, and that hurts the bottom line for businesses too. And what you're probably thinking is, well, if businesses would just give their employees raises, then that would mean that everybody could spend a lot more money, and that is definitely true. Think back in 2020 when everybody got stimulus checks, then everybody went out and spent this money. The problem is eventually people catch up and everything kind of catches up, including prices. And with demand spiking for just about everything, that means prices will eventually meet where demand is. And now you need a whole lot more money. Basically, it works like this. People don't make enough money, so businesses give out a raise, and then people can go out and buy more, but businesses are only producing so much, and they only have the means to produce so much. So then they have to produce more, and that comes at a cost. And what they then do is trickle those costs down to Americans, so then Americans are now paying more, and eventually Americans aren't making enough again, which means businesses have to give out a raise. This is called the wage price spiral, and it can get out of hand in your economy if you're not careful. So businesses can't just give out unlimited raises all the time, because that wouldn't really be a solution either. We need price stability, and that is exactly what the Federal Reserve is working on. They want to lower demand so much that people have a harder time spending money, and that gives the supply of things and the price to catch up to where demand should be, and prices should even out. People won't need crazy raises on top of that because they're able to afford most things. But where we are right now with credit card debt is, well, we haven't quite got there yet. So prices are still really high, and wages haven't really gotten close enough to meet them. So now you have Americans who are spending more than they should on credit cards. This is a big issue for two major reasons. The one, again, has to do with the Federal Reserve, but it more importantly has to do with interest rates. Interest rates on your credit card are adjustable, which means every so often, whether it's quarterly or monthly or annually, a credit card company is going to charge you interest for using their money. Credit card interest rates are extremely high because the barriers to using a credit card are extremely easy. You can get a credit card and go spend on it pretty much right now, and you can spend thousands of dollars. So because of that, the trade-off is you now have to pay an extremely high interest rate. Credit card interest rates range from around 10% APR to over 25% APR. So that means at the end of the year or the quarter or the month, the bank or the financial institution is going to charge you an annual interest, and that can sometimes add hundreds of dollars to your monthly payment. But like I said, credit card interest rates can be between 10% and 25%, and that is adjustable based on Federal Reserve interest rates. These financial institutions and banks that control your credit card, well, they get their money from the Federal Reserve. So if the Federal Reserve makes it really, really difficult for a bank to get its money, that means they're going to make it harder for you to use theirs. So basically, with the Fed raising interest rates, that adjustable rate on your credit card is about to go way up, meaning all of that debt is getting a lot more expensive. That kind of creates an interesting issue for the United States and our debt problem, because now you have Americans who are already struggling to get by, and on top of that, they're about to be hit with some really high credit card payments. With those credit card payments going up, well, that makes it a whole lot harder for Americans to dig themselves out of this debt. But the bigger issue that we're running into is we don't know how long this is going to go on for. Sure, the Federal Reserve has so far made an impact with its interest rate policies, but that is going to affect a whole lot of other things. I mentioned layoffs before, but depending on what the Federal Reserve does with its interest rate policies and how aggressive it gets, we could see a whole lot more layoffs and unemployment in 2023. That is going to make it next to impossible to pay off all of those credit cards. That could ultimately send our entire economy into a recession recession because now you have millions of Americans who, one, don't have a job, but two, can't pay their bills. And because inflation is still pretty highly elevated in our economy, that means the Federal Reserve most likely is going to continue to raise interest rates throughout 2023 and into 2024. So that means that Americans are going to have to continue to go after these credit cards and spend on their credit cards more than ever. What that is doing is creating a serious debt problem. And like I said before, this is going to make it impossible for many Americans to go after wealth or to get themselves out of this major debt in the future. That is what typically happens during times of really high inflation and or a recession. The rich end up just getting a whole lot richer and the poor get poorer because the poor have to rely on credit cards and they have to rely on loans in order to get themselves out of financial situations. They don't have that financial education and the basis to protect themselves against all of these issues. Meanwhile, the rich know how to use money and they can coordinate to actually make themselves richer during a recession. But again, this is going to affect a lot of our other industries with the Federal Reserve raising interest rates, with Americans unable to spend more. Well, that means businesses are going to see a lot less money, which is going to bleed out into our economy and affect jobs and affect everything that we buy. Of course, inflation will go down, but at what cost? Now, this is sort of the debt situation that we are in the United States. And like I said, depending on which way the Federal Reserve decides to go, well, then we could see credit card debt go up even more throughout the country. If the Federal Reserve was to lower its benchmark interest rates, well, that would mean more demand in our economy. It would mean people would be able to spend a lot more money because they would have a lot more money, but they'd also push themselves further and further into debt. And it's not even credit card debt if you really think about it. More people have mortgages than pretty much at any other time in US history right now. Auto loans exploded over the last couple of years and are now being repossessed because people can't make their payments. And you have credit card debt going up. So all of this overspending, all of this money that is out there, well, it's going to cause a serious problem. The Fed has a job to do to kind of reel it all back in. So we know the Federal Reserve can't really go that route. They can't lower interest rates and spark all of this demand because inflation will just get worse. And that means credit card debt needs to be handled now before things get a whole lot worse. If you have credit card debt, you need to make it a priority. You have to set a budget and try to pay off as much as possible. On the flip side, if you can eliminate most of this credit card debt, well, now you have an opportunity to capitalize on spending and investment in 2023 and 2024 because you are freed up from all of this debt. You can then grow your wealth a whole lot faster because you're not held down by all of this debt. And if you become wealthy over the next couple of years, then you won't have to worry about a potential recession because you will be prepared. All of that comes from understanding how money works. It comes down to financial education, which is what we talk about on this channel 7 days a week. Preparing for a crisis today is going to help you to avoid one in the future. But for most Americans, it seems like this debt crisis or debt bubble is only growing. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.